So I've made money out of this market, but I was greedy. I was reading too much of the news about the call options that were bought in volume for December. That's fundamental. It's long-term. You could go down $1,000, $500, and then still end up at 20,000 at the end of the year, maybe. If that was to happen, it's not a prediction of mine, but there is some high volume money that moved in.
I think if you look over the next decade, the gold price, at least the nominal gold price, will do well. I don't think that the pace of increase will rival the pace that we enjoyed in 2025. So the listeners that you have who believe that the gold price will double in the next 12 months will be needlessly disappointed.
Sharp market moves around geopolitical events often create the illusion that prices are reacting suddenly, but much of the positioning may have already happened behind the scenes. Markets frequently operate on the principle of buy the rumor, sell the fact, where insiders or large players position themselves well before the news becomes public. When the anticipated event finally occurs, prices may initially spike but then quickly reverse as early buyers take profits. Fransis Hunt explains that in this market move, gold priced in euros presented the clearest technical setup rather than gold priced in dollars. The expectation within his trading community was that the US dollar might receive a temporary haven bid, which indeed occurred as the dollar index strengthened while currencies like the euro and Australian dollar weakened. Using the HVF method, the trade developed through a structured pattern of entries and pullbacks, followed by a fractal formation before the weekend. When markets opened with a gap during the Sunday session, the optimal strategy according to the system would have been to fully exit the position near the peak. Fransis Hunt also points to unusual market behavior surrounding the final day of options trading, including a reported glitch affecting markets such as silver and natural gas. He suggests that large players may have been under pressure due to delivery obligations and quickly pushed prices down to reduce exposure and flush out open interest. The rapid decline forced many leveraged traders out of positions before prices stabilized again. While the broader trading framework worked effectively, he admits that his own execution was imperfect. In hindsight, following the strategy strictly would have secured far greater profits and avoided the volatility that followed, reinforcing the importance of disciplined trade management even when strong bullish narratives dominate the news. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying close attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
So a couple of thoughts that come out of that is, in many instances, the insiders move the market most and have the biggest clout, and they were already moving the market well before this attack and knew it was coming, meaning that to a much larger degree than maybe all of us realized, this event was fairly well priced in. It was just waiting for the hammer to fall. And in actual fact, it becomes almost a buy on the rumor, sell a little bit on the fact. In fact, I've got our personal choice of trade, which was the gold euro on right now, that highlights this point. We, ironically, in our community, we saw the best setup structure was actually not against the dollar. So we were inadvertently predicting that there could be a bit of fear bid for the dollar, and we had the dollar index actually move up, and we had the Australian and the euro. The euro is very commonly available, gold in the euro terms, and this was our technical setup that we traded right here. And you can see we made our first interim, we got a pullback. We made our second interim, which is where we expect pullbacks. You got a pullback. You set up a fractal, which is a smaller version of the same pattern, going into the week end of the previous weekend. And then the Sunday session came, and you can see the gap open here. And in actual fact, the best thing to have done would have been to have sold everything. HVF method has played a blinder on this. My problem was I didn't adhere perfectly, and as an operator, I've played a 5 out of 10. So I've made money out of this market, but I was greedy. I was reading too much of the news about the call options that were bought in volume for December. That's fundamental. It's long-term. You could go down $1,000, $500, and then still end up at 20,000 at the end of the year, maybe. If that was to happen, it's not a prediction of mine, but there is some high volume money that moved in. But I was too greedy. I didn't want to close. I closed 30% and I was happy to hold on. I thought we were going to get a walkout new high. And I had excessive bull bias. Has to be the case. Too much of this reflate move from here was probably based on the Iran thing. In fact, the entire slap in the face was probably a bit of a leverage reset. They wouldn't have wanted to do the attack when you were here, because you would have potentially gone higher. They wanted all of retail flushed out and given a slap in the face. So in hindsight, you look at a lot of things. I mean, if you're thinking about the CME group with their glitch that was on the last day of option trading and affected silver and nat gas markets, you've got to look at these guys desperately needed out on the last day. That was about a Thursday or Friday, I think it was. I'm going to be off by a day. And then we had the attack on the weekend. No wonder they went so far to do the most obvious scam. The owners forced this technical, and it was quite a long time. The natural gas was up quite quickly. They took it down at 12.15. Natural gas was back up 12.45. They took silver down 12.15. That was only 1.45 that it came back up. So you're talking about, I think it's 1.45, might have been 1.15, but a much longer period. And that would have been a lot of phone calls. And now they've marked to deliver and bought for $86 and $81, much cheaper on those contracts. And they would have rushed to get that price down, which is when they flushed out the open interest. You might recall there was more likely to be delivered than there was supply. And that open interest differential all got quickly sorted out in that hour window on the last day of an options contract. I mean, it's absolutely absurd. But that the fact that they would do such an obvious thuggery, clear, compromised expose of the CME, clearly the carrot to get it done was the fact that they didn't want to go into this weekend that just passed with the events that ended up transpiring, needing to get fulfillment on silver, because it could have been a lot higher with what happened. So funny enough, the gap opens on the news. We made it to target, and then since then, as often the case, substantial pullback. So my main problem was I probably had about 5 times more profit that I could have made if I just executed more accurately on my own strategy. So I give myself low execution points, but the HVF method was perfect. You would have sold the top there, very close to the top on that wick, and you would have been out, and now you're sitting down here, and you would have avoided all of this volatility. So a little bit of a concern for me after with these slapdowns. We've had that, and this is pretty meaty slapdown. It's not of the same scale, but there's a little bit of a grind up and slap down vibe about this. If I'm drawing technically, I would say, you got a little bit channely like that. You got a nice little fractal there on the splitter. It's on the midpoint that pushed you to the other side here. There was your other side. There's a little bit of a rising channel stroke. I don't want to say flag, but it could be a little bit rising wedge-like. You could dip again to the bottom. Anything could happen here. I don't see it as a high probability entry point now. But often, after you've just had a little bit of volatility to the downside, you tend to drift up. You can see this is a genuine grind upwards, but it gets quite regular. It's getting more regular now. Slapbacks. I really think they didn't want a new high on gold there, and that came in really hard and strong. But I find myself wishing I just closed 100% instead of a third.
Precious metals investing often begins with a simple contrarian idea: buy what is widely disliked and wait for sentiment to change. Rick Rule explains that he originally bought silver years ago when the metal was deeply hated by the market, expecting that once the negative sentiment faded, the price might double. Instead, silver eventually quadrupled, and as a disciplined speculator, he chose to sell the position once it had achieved the goal he had set. After reviewing other opportunities, he concluded that while the metal itself had likely run its course as a speculation, silver mining stocks were still priced as if silver were around $45. With the metal trading much higher, those stocks still offered potential upside, so he reinvested roughly half of the proceeds from selling silver into silver mining companies. Rick Rule also notes that today's silver market does not reflect a true institutional shortage, even though retail products such as small bars and coins can sometimes be tight. Large wholesale, good delivery bars still exist, but the number of paper contracts outstanding is far larger than the immediately deliverable supply. In such situations, exchanges are unlikely to allow a true physical squeeze because they can halt trading or settle contracts in cash if pressures become too extreme. Looking ahead, he believes gold and silver prices may continue rising but probably not at the explosive pace seen recently. Even if metal prices move sideways, mining stocks could still appreciate because many are still valued below current metal prices. The key, he stresses, is to remain disciplined, avoid unrealistic expectations, and invest based on facts rather than excitement. Let's get back to the interview.
Something much simpler than that. I bought silver some years ago because it was hated. And I believed that when the hate dissipated that the silver price could double. I was wrong. It quadrupled. But I'm an old guy and I'm a disciplined speculator. When a position performs the way I had hoped, I sell it. I looked at my silver position and said, as a speculation, it's run its course. So benchmark it against some other speculations and see if it stays in the portfolio. What I discovered was that the silver stocks themselves were being valued by Bay Street at about $45 silver. Therefore, if the silver price held constant at 75, by definition, I wouldn't make any more money on silver, but I could still make money on the silver stocks. Conversely, if the price fell, because of the implicit discount in the silver stocks, while their prices might fall, their values wouldn't. So about 50% of the money I made by selling silver, I put into the silver stocks. But remember, for me, it was a speculative position. What really happened is that silver ceased to be hated. I got the price appreciation I wanted. Sold it, moved on.
And I feel like, the audience needs to know this. I mean, they sometimes forget that the fundamentals are, buy low, sell high.
Correct.
And you redeployed it into the miners. So talk to me a little bit about this attitude on the ground today. I mean, there's a lot of people at PDAC this year, a lot of people excited about these prices. Good deals out there?
I don't know if there are good deals. There are people doing good work. I'm starting to see the exploration expenditures that came into the system 12 years ago, 13 years ago, starting to bear fruit. And one of the things I've learned being 73 years of age is when the industry, as an example, moves into a new area or a new method of exploration, it takes a decade for it to work. So we're now seeing the fruits of exploration expenditures that occurred pre-2010. I think Eric's probably right. 2 years ago, I would have disagreed. I still remember the inefficient capital allocations by the seniors in the period 2000 to 2010. That was a period where the gold price was up sixfold and the free cash flow per share of the senior indexes fell. That took real courage. I think now probably the investment community has asked the senior managers to be too cautious with money, and they're going to come into a period 2 years from now where they are asked to at least grow or maintain production. The people like Agnico Eagle that are ahead of the pack will continue ahead of the pack, and the people who aren't will, as Eric points out, be scrambling to catch up. And part of that's our fault. When I say our fault, I mean the investors. We asked the mining companies in that bad decade to grow at all costs. They did, and the cost turned out to be too high. We've probably asked them to be too cautious. I guess I'm too close to the silver market. The first silver squeeze, I was still at Sprott, and the Sprott Physical Silver Trust was adding assets like crazy. We had to go buy silver. We had some hairy moments, not because of the market, but because our own buying was so heavy. But there was never a squeeze in wholesale silver product. The circumstance that we have today is, in terms of good delivery retail product, 1 ounce product, even up to 1 kilo product, it's short. There is no shortage of institutional product. There's no shortage of good delivery for people like the Sprott Physical Trust. There is a shortage of good delivery on deposit of COMEX. If we can get through the next 3 or 4 months, that solves itself. The dealers are reluctantly buying back non-good delivery silver, shipping it to the refineries, and it reappears as good delivery. In the interim, the circumstance that we have is that the outstanding paper contracts greatly outweigh the amount of silver available for good delivery. Now, the silver squeeze people need to understand the way the exchanges work. The exchanges are owned by the members. The idea that you will ever actually catch them physically short so that they get bought in for cash will never occur. The exchange will declare force majeure. They'll cash settle. They'll halt the contract. They'll cash settle, wipe their hands and go away. The idea that you're going to catch JP Morgan Chase or Conti or any of these guys physically short is nil. It's a non-starter. It will never happen. If you look back to the tin trade, the nickel trade, when the dealers get too far offside, what it's going to cost them on their balance sheet? Force majeure, suspend the contract, cash settle, drive on. I don't think that the pace of increase will rival the pace that we enjoyed in 2025. So the listeners that you have who believe that the gold price will double in the next 12 months will be needlessly disappointed. Let's say it went up 10% or 15%. Yeah. Let's say, too, just for fun, believing like Eric Sprott, that the gold and silver companies discount fairly substantially the current price of gold and silver. If gold and silver just went sideways, the stocks need to go up to catch up. So there's lots of room left in this market, assuming that your listeners don't have overinflated expectation. I think that's the important thing. I think don't lose your head about where we are. There's great advantage coming. If you keep your head and you play the game just with the facts at hand, as opposed to exaggerating that in your own mind, you're going to do very, very, very well. If you make mistakes in a market like this, it's tragic. There will be a lot of people who conspire to lose money in this market.
The outlook for gold and silver suggests continued opportunity, but it also calls for discipline and realistic expectations. Much of the easy gain in the metals themselves may already have occurred, particularly after strong price advances, yet opportunities can still exist in mining companies that remain valued below current metal prices. While retail shortages and large paper markets can create dramatic narratives about squeezes, the structure of exchanges makes a true forced shortage unlikely, as contracts can always be settled in cash if pressure becomes extreme. In this environment, investors who remain patient, avoid emotional decisions, and focus on fundamental value rather than exaggerated market stories are likely to benefit the most as the precious metals cycle continues to evolve. Could gold and silver mining stocks outperform the metals themselves if gold and silver prices remain stable, simply because many mining companies are still valued below the current market price of the metals they produce? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.